SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner of Search Fund Ventures and founder of SMB Investor Network. And today I'm joined by Brian Wolfe, who's got an extensive career starting, selling, managing transactional processes in the lower middle market and small business land. So I'll kick it over to Brian to give a brief intro on himself and on his firm Funded Ventures.
Great. Thanks for having me. I appreciate that. So maybe just to rewind a little bit, I worked for a couple of years at Amazon before I went to law school. And came out and joined a large law firm, sort of one of the main law firms that does private equity M&A, and spent 17 years there doing a lot of very traditional, plain vanilla private equity M&A for leading sponsors. And a lot of what financial sponsors do today, they do roll-ups, right? They find an industry. A lot of this will sound very familiar to your audience who knows a lot about ETA, but
Absolutely.
they like an ETA, they find a highly fragmented industry that they like. They make an anchor platform investment. They find an operator who's proficient at that industry, and then they start to do bolt-on M&A. And of course, the reason why they do that is, if you can get your platform growing both organically as well as via M&A, there's a tremendous amount of opportunity for multiple expansion. And so I had been doing deals at Kirkland for a lot of these well-known sponsors, think like Bain, THL, Vista, GTCR, guys like that. And I was also investing in a lot of private equity funds as a passive limited partner. And I was really seeing these roll-ups up close. And I was really entranced by, when things went right, how significant the impact of multiple expansion would be to your equity returns. Now, I've said this before. Warren Buffett often says that compounding is the eighth wonder of the world. I'm pretty sure multiple expansion is the eighth wonder of the world. And so, after being at Kirkland for a bunch of years, I live in this neat town actually near where you grew up. And I started to talk to a lot of the dads at these school events or at our church events. And they were private equity investors, they were operators. And I said, listen, I've been doing these deals as an intermediary, as a deal lawyer for a bunch of years, sort of like thinking about leaving or getting more involved as a principal. I got really lucky. A couple of the guys in our community actually teach ETA and search funds at the University of Chicago. Some guys in our network who are at Shore Capital, which is probably the most active lower middle market private equity firm in the country right now. And all these guys were like shaking me loose. And they basically gave me an education on ETA. They said, listen, you've been seeing these deals happen sort of up market. You should do what we do, whether as an independent sponsor, as an investor, as an operator. You should go down market and start to look for an asset at $500,000 to $1.5 million of EBITDA that you can buy for 3.5 times, 4 times STE or EBITDA. And I really that planted the seed. And what I ended up doing was I ended up finding a partner here in our community who had bootstrapped a small SaaS company. He had an exit to private equity, but he didn't exit for a lot of money. But you could tell he knew something about something, but he still had that hunger in him. And he said, listen, I heard you've been exploring some of these things. You have any interest in partnering with me? He had bootstrapped his first startup. He's like, I don't want to do that anymore. That's really, really, really hard. Greenfielding something's really hard. He said, why don't we get together? We both have great networks. And why don't we go out and find an asset and build it both organically as well as via M&A? And so in 2017, that's what we did. We had a very specific thesis around SaaS. And the idea was, at the time, everything was about the rule of 40 in SaaS, which basically means that there are two things that drive the valuations of SaaS companies, of software companies. The first is your margin, your EBITDA margin, and the second is your organic growth rate. And what we found was there were a lot of very high quality subscale SaaS assets that didn't have a lot of churn. They were doing a really good job of meeting their customer needs, but they weren't growing much. And the reason they weren't growing much is because they were being run by bootstrap founders who often had moved on to their next startup. idea, or decided that they wanted to buy a house, or they got married, or they had a kid, and they decided they wanted to start taking some of that excess cash flow out of the business at the end of the year rather than reinvesting it in sales and marketing. Of course, once they did that, it had a significant impact on their growth trajectory. And so our thesis was that we could come into a highly fragmented space. We chose MarTech, that we could buy businesses that were high quality but low churn for like 1 to 2 times revenue, that we could put those companies together and grow that platform both via M&A as well as organically. And again, organically is really important in this space because organic growth significantly impacts your valuation multiple. And our thesis was that if we could find some of these low growth SaaS assets and buy them for 1 or 2 times revenue, and we could underwrite and get the growth trajectory north of 20%, we thought we could sell that platform more for a normalized valuation multiple, which at the time was somewhere around 5 to 6 times recurring revenue. And so that's what we did. We ended up buying 3 businesses. We put them together. We spent a lot of time on the product side. We spent even more time on the sales and marketing side. And we were able to grow that platform. And we ultimately exited that platform in 2019 to a large private equity firm, Alpine Investors. On the other side of that, I had remained at my law firm, but I started to really wind down a lot of the day-to-day practice of law that I was doing. And I started to really ramp up my investment into the ETA community. I had taught a class on private equity at Washington University in St. Louis for about 10 years. I started to teach their business school class on ETA and search funds. And then I started teaching that class at the University of North Carolina as well. I'll teach ETA this fall at night at the University of Chicago booth. And what I also started to do was I started to work with some of my former students who had a high level of conviction on this subscale M&A, and they wanted to go out and find a small business and buy it and grow it. And that's sort of what Funded became. Funded became this vehicle to be able to continue to mentor and work with some of my former students to help them go out into the market and do their own self-funded search and acquisition, and work with them, of course, on the other side, to do the hard work, which is figuring out how to grow these resilient Main Street small businesses. So earlier this year in February, I finally, after 17 years, left the law firm that I'd been at. And now I'm focused, full time, 120% of my time on building Funded, on helping the existing partners of mine complete their acquisitions, get into the seat, become proficient at operating. And then we're hopeful that these folks will also be able to do some bolt-on M&A and use a playbook a lot like the playbook that I had used back in 2017 to 2019 in that SaaS roll-up. So that was a lot, but hopefully that gives you an idea of some of my background and a little bit of detail about Funded Ventures.
Yeah, I mean, what a stellar resume and kind of track record to be able to not only bring that to your students, but to folks that you're backing at Funded, right? I mean, when you've been not only through a successful search process that does exactly what searches are supposed to do, which is exit up a buyer, right, to someone like Alpine, you've also seen lower middle market transactions throughout your entire career. So having that kind of lens on and purview of all sides of the market, I imagine that gives you a great perspective to help folks that maybe, might have gaps in some of those areas and might struggle to be a qualified searcher without you. Is that what you're finding, or?
No question. There's a couple of things. There's always the substantive side, and then there's the conviction building side. So on the substantive side, it has helped to be able to have that pattern recognition and to be able to say, this is another one of those, right? I saw something like this. Maybe I saw this, or I saw something analogous to this a couple of years ago or 5 years ago, up market. So that's been really, really, really helpful. On the conviction building side, though, that's equally important. You have a lot of folks who really want to become first-time operators. They may have the resume to really support going out and doing it. But a hard part about going out and doing an ETA project, it's the conviction building. It's getting the confidence to be able to negotiate deals. It's getting the confidence to go ahead and sign your name on the dotted line. When you get to a closing, you've got to take on the bank loan. And so one of the things that I think I've been able to provide from a mentoring perspective is to be able to give my partners a level of conviction to be able to charge forward at times because they haven't seen the thing before. They might not intuitively be quite as confident on their own to make that decision or to take that next step forward.
Yeah, we hear that a lot. As you know, we go kind of between the independent sponsor world, the lower end of that independent sponsor market, and the self-funded search world. Certainly in the self-funded search world, when you have someone who's got, tremendous operating experience, they've been a P&L leader at probably a private equity backed company, and they've seen companies go full cycle, but haven't necessarily been an owner to the degree they would be if they executed a self-funded search. The deal making part is often the biggest challenge for them. And what's interesting
This is the joke, right?
Right.
The joke is the process that you go through to find a deal is really not that similar at all to the process that you go through when you're an operator. And, I would say as an investor, that search process can be a proving ground. I mean, there's a phrase that I always like, which is winners win, right? You just have people out there who are able to figure out a way to get it done. And that's certainly true. But I absolutely agree with you, which is, you know, the value creation happens in the second step after the M&A, after the closing. And there are a lot of folks out there that are really, really, really good at influencing their team, building culture. But the tool set that you need to actually find the deal and close on the deal is way different. And a lot of folks out there with good operational experience may not have that tool set developed. And that's where someone like you or someone like me, I think, can especially add some value because we've had that pattern recognition around what's worked in the past in terms of doing a deal, negotiating a deal, getting to the closing table.
Yep, that's exactly right. And that's a core part of our approach is to, we always challenge ourselves when we see a presentation or a data room or something that feels incomplete. We ask ourselves, is this incomplete because, to your point, this person's not a winner? Or is it incomplete because the person doesn't necessarily have transactional experience, but they are a winner and we can help them win? So that can be a real competitive advantage for investors like yourself, for us, and anyone listening to this, right? As you look at more of these deals, make sure you're not passing on things just because the sim isn't formatted well, right? You want to ask yourself, is this a person that is certainly qualified to run the business, but might not be the best deal maker?
It's really hard. Like a lot of subscale M&A are a series of judgmenty decisions. There's always warts in these deals. There's always deficiencies. And it's really, really, really hard for a searcher who's going through this the first time to know from a judgmenty perspective, where is that line? Where is this just messy? Where was, during diligence, what does it mean if the answer is maybe a little bit incomplete versus, wait, my antenna's up. It just doesn't sit right with me. And living within that world of ambiguity, incompleteness, that's just inherent at the subscale end of the market. And that's another reason why having some partner, whether it's your investor, whether it's a river guide, whether it's some sort of advisor, having someone who's done it before, it can be really valuable, not only to try to get to the right answer, but frankly, just to move a lot faster. Because when you hit some of these judgmenty decisions, it causes you to sort of pause and stall, and you want to move forward, but just don't know. It feels a little like, and so building that network, figuring out a way to sort of lean on somebody else who's done it before, it can be really, really, really valuable. I would almost say not having someone like that in your corner, I think, is a real miss.
Yeah, it's definitely a risk. And the traditional search world has gotten so good at that, right? So many of the traditional search funds emphasize their mentorship. They emphasize the fact that in many cases the partners have, done it before. You're going to say something. Go ahead.
I was going to say is they certainly market that very well, but I would just say that even in traditional search, my experience is traditional search does a much better job after the deal gets done. They're now on your board. You have quarterly meetings. You have during the search, you're still largely alone. Your traditional search fund investors, maybe you got 10 or 12 of them. Each of them only owns 8% of your cap table or 10%. It's not as though you're able to pick up the phone and constantly call them, because these judgment-y issues show up all the time. And so I do, just as a side note, I would just say that traditional search has done a good job post the M&A closing, but during that search process, I'm not quite sure that even searchers there have a lot of robust ongoing support when these issues arise.
Yeah, no, that's fair. And one of the questions we get a lot when we talk to folks that are early on, they ask, generally they're asking questions about how do we appeal to investors, or how do we truly build and nurture a network of investors? And what I tell them is run your search like it is the business, right? Send out monthly updates or as frequently as you can that show your KPIs. How many deals did you source? How many NDAs did you sign? LOIs? What did you learn? What are you seeing in the market? Run it like you run the business. And I hope that advice has helped folks. I mean, we now are on a bunch of newsletters from searchers who send these out. So I think, to your point, Brian, many folks may market being supportive during the search, but at the end of the day, the searcher themselves has to hold themselves accountable, because no one's going to do that.
There's no question. And the neat thing is they don't even need to be novel. As you just mentioned, there are all sorts of best practices that have developed in the market around how to professionalize your search, not only from the actual cold outreach and what are the right email tools, but to your point, from an optics perspective, how you brand yourself in your search. And I think a lot of those things are really, really, really valuable too, because getting back to that winners win paradigm, people who are constantly focused on incorporating best practices and rigor, and they're up at 7:30 or 8 in the morning and they're working all day, and like, potential investors, they're not dumb. They can sense that too. And so I think it is really, really incumbent on the searcher. Doing a search is a very, very lonely process. And so you've got to figure out a way to be able to sort of almost go overboard in terms of not only utilizing best practices in your search, but also how you're building a network, how you're talking to your network, how you're providing updates. Inject a dose of empathy. It's not always going to be a sunshine day, but I think those things are really, really, really valuable. They're certainly very valuable to me. When a searcher reaches out to me as an investor and wants to have a conversation, I can usually sense pretty quickly whether they're a serious person or whether they're a not serious person in my mind. And sort of my judgment around that will have a significant impact on how much time we spend together.
That's great. Yeah, why don't we get into that a little more? It's a question I ask frequently, especially to folks who are more focused on either partnering with searchers or, sourcing operators. I'm always curious to understand, how do you evaluate folks? And a lot of people say, like you just touched on, it's more about the attributes than the technical skills in many cases. You want to see that empathy. You want to see that, a good word I've heard is tenacity, right? You want to see those sorts of things. So what do you look for? How do you suss it out? All that stuff.
A little bit unique here. And, so obviously this is a data point of one, but it's usually very important to me that I have an existing relationship or some strong nexus with the searchers I'll invest in. And so my view on this is I spent 600 hours on partnering with one of the first searchers that I worked with. I really like having a high batting average. And I also think that it's like important for someone in my shoes to continue to have the muscle memory and develop, the experiences being in the suit that'll help me to be able to help the other people that I work with in the future. That doesn't make like economic sense, but I'm doing it not for that particular searcher in my return on the investment of my time with them, you know, just necessarily. I'm also trying to create something that I can sort of leverage for all of the people that I work with. And so because of that, because I often spend so much time with the partners that I work with, it's really, really important that there's a high probability that they're going to be successful. And so the things that I look at first, what I want to see is that like they just have a history of success on a repeatable basis. This is just someone who, They probably did go to a pretty good undergraduate school. Maybe they played sports there. Maybe they went and they got their MBA. Maybe they served in our armed forces. It doesn't have to be just that top MBA program. You can sort of, see a series of attributes in a bunch of different ways. But what I want to see is that this is someone who is objectively smart, who is an objectively hard worker. And I want to see someone who wants to win. And if you have those three things, plus you have a high level of ethics. When I talk to you, I'm not feeling any sense of blustery. I'm not feeling any sense of, no, it's not that hard for me. I'll crush it. I don't want to hear any of that stuff, right? I want to hear some empathy. I want to hear some honesty. I want to hear the guy who may not have graduated at the top of his class, but who really understands and has that grit to show up every day, to be a good listener, that they're going to be willing to be malleable from the mentorship that I provide them. And if I can find somebody who will wake up at 7:30 in the morning and start their search at 8 or 8:30 or whatever, and find a way to stay busy all day, finding new industries, different geographies, doing cold outreach, improving it, jumping on the phone, going through the SIMs. If they can go through 7,000 SIMs over a 12 to 18-month period and have a robust proprietary outreach program, I'm pretty certain that they're going to get some really good looks at assets. And that's what I'm looking for. What really frustrates me is the guy who on Monday will send me his deal funnel and there'll be like two things in it, right? Like that just doesn't work. And so, those are some of the attributes that I'm really, really focused on. I think for me, because bolt-on M&A is such a huge part of my playbook, I don't need to do big deals with people on day one. What I need to do is curate great people who can be great operators and get in there and become great operators. And a lot of that equity creation can come both from the organic growth as well as the bolt-on M&A. And it can happen over a series of years on a compounded basis. So I'm not spending as much time as a lot of investors are modeling out IRRs and spending a lot of time being too prescriptive on the front end around these are the industries and this is the only size that's going to work and all that stuff, because I know that if I find great people and they want to stick around with me, not just for 5 years, but for 7 or 9 or whatever it is, I have a high level of conviction that we can create a lot of value together.
That's great. So, taking that people first approach, especially, if you focus on malleability, I think it's a great word, coachability, that is almost a prerequisite for you to even be able to add value, right? Because if someone's not going to work hard and listen, they're not going to get the value from you.
They're not going to be efficient. If someone doesn't believe in, when we talk, what I'll share with them from a best practice perspective, or if I put them in front of somebody in my network, what that person in my network tells them, like they're just going to move slow. And I don't want people to move slow. I want them to move fast. I want them to have a high enough level of conviction that I'm going to give them everything that I've got. And I will. I give them everything I've got. But the trait on that is that they have to have a high level of conviction in me and in my track record, in my network. And if we're both bought into that, we can move really, really, really fast, because then it's all about execution.
So when you do find someone, they've been in your network for a while, you've probably gotten to know them over a handful of years. What is the first steps to creating a funded operating partner relationship look like? Do you define a thesis, or do you, just hit the ground running? How's that work?
Often what I'll do is I'll spend a lot of time with the person. And then oftentimes what I do is I'll put them in front of usually 5 to 7 people in my network. Most of them are either close friends, maybe they were business acquaintances, but they've become close friends. I've got a board of advisors that funded. I'll put them in front of the members of the board of advisors. And I want to get like a collective view, because oftentimes what happens is the folks that I'm thinking about working with, they're still very raw. So let's fast forward a little bit. Oftentimes when we'll decide to partner, one of the first things that I'll do is that I'll put them in front of 50 people over the first 50 days. And it's very intentional. When you ask somebody who's starting a search to tell their story, like as if they would tell their story in front of a seller, it's usually going to be twice as long as it should be. I had a boss at the law firm that I was at who's one of the best transactional lawyers in the country. And I used to write these long-winded emails and he'd say, stop, just be punchy. I always think about that concept, punchy. And when you're in front of a seller, you need to be punchy. Telling the seller that you played lacrosse in high school, it's totally irrelevant. And a lot of the things that first-time searchers say on those initial calls with sellers, it's not relevant. Or in some ways, it's actually destructive to the messaging that they should want to leave that seller or that sell-side broker with. So one of the first things that I do with searchers that I work with is I put them in front of a huge number of people just to tell their story. And inevitably, the reviews will be lukewarm. Folks will say like, man, she was all over the place, or he was all over the place, told me all this stuff that doesn't. And what I want them to do in those first 30 to 45 days is to develop a punchy story about who they are and what they're trying to achieve, what they're trying to buy, who they are. What I find is there are a lot of searchers who, even 4 or 5 months in, if you don't go through that process, they're still meandering. They're still not a front of the house guy in front of a seller, in front of a sell side broker. And it has a significant impact on their ability to be able to move their deals forward in their deal funnel. So that's one of the first things that I do. But I spend a lot of time with these searchers, both before we decide to engage together as partners, as well as during those initial 60 days after they've started their search, to make sure that they can hit the ground running, make sure that they've got the right tools for their search, to make sure that they're writing the right emails, that the emails are punchy, that the subject line's punchy, that they're hunting for the right industries, and that they convey why they're hunting for the things that they're hunting. So I spent a tremendous amount of time up front. And not only do I spend time, I mean, one of the neat things about working with people who are my former students or in my network is they all want to work together. These are like good guys. Some of them know each other. And when you have that situation, it creates a lot more operating leverage. It creates these situations where there's a new young woman who's joining the team. Could you guys all meet with her and just explain to her some of the best practices that we use and which tools we use and what's been working for you, or how to warm up email addresses, and folks are so much more willing to do that when it's all sort of coming from within their network. And so that's one of the reasons why at Funded, I say we're unapologetically focused on the Midwest. My view on this stuff is we want to stand for something. And I think that ET in particular is specifically a Midwest game. 80% of venture dollars go to 3 states on the coast. That's great. I think that the Midwest is really, really well positioned for ETA. So I look for Midwest searchers who generally want to stay around the Midwest, who could talk to Midwest sellers. I always say, I don't speak California, right? So we want to develop this culture that we all share, and we want to cross-pollinate, and we want to figure out a way where it's very infrequent when we're guessing on anything. You know, one of us has probably seen that thing before. And so how do we figure out this spirit where, yes, we're all running our own searches, but we're also cross-pollinating and sharing best ideas, and maybe even sometimes sharing deal flow to create these situations where 1 + 1 = 3.
That's really neat. And that cuts to the heart of, to your earlier point, how lonely the search can be.
It's really, really, really hard. And we've played around with these models. We haven't done it yet, but I had 2 searchers who were both chasing at the time. We were very interested in medical spas, which we're no longer very interested in. But for about 3 or 4 months, we were actually under LOI for a leading medical spa up in Wisconsin. And we were thinking about going under LOI at a pretty significant medical spa in the northern suburbs of Chicago where I live. And 2 of my searchers knew each other. And one of them was thinking about chasing the Wisconsin medical spa, and one was chasing the medical spa in the northern suburbs. And the idea was, and I think this is really interesting, it's very hard to pull off, but what they were going to do was they were going to create an artery between the two of them. The medical spa in Wisconsin was sort of around Milwaukee, so not too far from Chicago. And they were going to build toward each other. And we would do some bolt-on M&A. And who knows whether this would have worked out. But I had this like amazing plan, thinking back about sort of the multiple expansion plan, that if they could eventually buy and build toward each other into a common area, there was the potential for both of them to sell their platforms together for a multiple of their EBIT or SDE, which would be far in excess of what either of them would have been able to sell their platform for. And like, I just think that that stuff's awesome. I'm not trying to come into this as an institutional investor. I haven't raised any third-party equity capital. For me, that's not what this game's about today. It might be down the road, but today I'm just so interested in how to construct what really is just three things: operators, capital, and assets, and how to construct them in interesting and advantaged ways to create outcomes that are unique and special, right? That's the game we're trying to play.
And you're also constructing kind of the Botox Railroad from the North Shore all the way up to Door County. And then whether you're at your lake house or you're at your home,
Yeah.
you can get access.
That one's not going to happen, but I just, a big part of this in life is this can be fun. And so it's a lot more fun. I always say life is a lot more fun when you do it with a partner, right? And so that's a really big principle for me. And so I have a lot more fun sort of doing it the way that we do it. I don't know if it's the most lucrative way to do it, but it's intellectually curious for us and we're having fun.
Yeah, well, that's important. It's good to like what you're doing, especially in your partial retirement.
Well, that's the joke though, right? Is I don't think I've ever worked so hard.
Yeah. That's how
I'm
you know
really
you love
excited
it.
about sort of what's next here. And I feel like we've got some really good pieces. We're trying to close 3 deals over the next 90 days. And if we can close them, I think that will help bring us to a new phase of all of this. But who knows? We might not be able to close any of them. I mean, these small deals are hard. I always tell people I think you have about a 30% chance of closing a subscale deal. Issues come up every day. And so, this is hand-to-hand combat. And I hope we close them because I'm really excited about this next phase, but we'll just keep taking it one day at a time.
Yeah, that actually raises one more, I think, topic I'd love to cover with you, which is you've got great pattern recognition. You've seen so many deals throughout your career and you've done a bunch as a principal yourself. But what kind of still slapped you in the face when you went from the lower middle market, to subscale deals? Like what surprised you or what continues to surprise you, right?
No, totally. I'll give you one thing that has slapped me in the face. So when I was working up market, when I was working at a large law firm on PE M&A, the sell side brokers that I was working with, I mean, think Goldman Sachs, think, Evercore, boutique investment banking firms. Our relationship was very transactional. Everyone was very sophisticated. We could yell or argue or whatever. And like the deals almost always still got done. It's way different down market, right? I've had deals break apart because I said the wrong thing to the sell side broker. Oftentimes, when you think of these small deals, the seller's never gone through the sale process before. So they are totally being driven by what their sell side broker is telling them if they've hired one. And so, like, I remember I had like a sell side broker tell me something that I thought was ridiculous. I think he was like, listen, the seller will agree during the exclusivity period not to go to talk to other potential buyers, but I, as the broker, can still go out and talk to other buyers or something like that. I was like, well, that's the most absurd thing I've ever heard. But the way I said it was arguably not very nice. The sell side broker actually like went back to the seller and said, this guy's a jerk. And I probably was a jerk on that call because I just thought it was like the most absurd thing I'd ever heard. But like that stuff happens a lot in the subscale end of the market. Saying the wrong thing on a call can really cause things to tip over fast. And so everything at the subscale of the market is just a little bit messier. It's a little bit more subject to cracking. And so I've had to rewire a lot for me in terms of my approach at the subscale end of the market that I didn't have to do when I was up market. When you're up market and you're dealing with private equity firms, everyone needs to get the deals done. That's why you exist. At the subscale of the market, this company might have been in this owner's family for 3 generations. The buyer's going to be in that community and representing that brand, which may be the name of the family that's owned it for 3 generations. So they really, really, really care about who you are and what you stand for as a buyer. And I've had to learn to rewire myself to be much more cognizant and much more cerebral about how I interact, especially with the sell side brokers at the subscale end of the market, because I wouldn't have thought that a deal could tip over the way that I've seen it happen before when I haven't sort of come into those calls with the right attitude.
That's a great tip. Yeah, there's a lot more emotion tied to deals, and like you said, there's not kind of a need to get the deal done necessarily in many cases. So people come in with very different incentives than they do up market. That's a great takeaway. Cool. Well, anything else you want to leave us with, Brian, before we close out?
No, I just would share, I'm really excited about a couple of things that I'm seeing in the space that I'll sort of leave you with. I mean, one is I'm seeing traditional search get really disrupted. I'm seeing the convergence of independent sponsor and traditional search. I'm seeing the convergence of private equity, which continues to come down market to the subscale space. I'm seeing in traditional search, equity investors coming in and now wanting to own a third, 50%, 60% of a searcher's deal. And I think in some cases they're going to be successful because the position that they're taking is that if I own a lot more of your cap table, I'm going to be a lot more incentivized to actually hold your hand during the search process. I can give you a lot of my proprietary tools so that you could do a better job of going out there and buying a business. I can give you access to my closed-ended funds from a private equity perspective so that if you do a deal and if you grow the company, instead of selling it in 5 years, maybe we'll recap it. We'll take one of our upmarket private equity funds, we'll have that fund buy your company and more of a continuation vehicle like transaction. And you could stay on. And instead of making 5 or 6 or 7 million bucks, you can make 15 million bucks, 20 million bucks, an infinite amount of money. And so one of the things that I'm seeing up close, and I really think if you start to extrapolate out where this is going to go, I think that it's going to start to get really interesting for high velocity first time operators having the ability to having a much longer relationship with the business that they buy, either through the recap, through who they partner with out of the gate from an investor. And I think what that means is it's going to be another reason why private equity is going to continue to come down market and move into the traditional search space, because what it's going to allow them to do is it's going to be just another sourcing engine.
Yep.
From an operator perspective and an asset perspective. Now they can pick those components up earlier and hopefully hold on to them for a much longer period of time as they move that operator and as they move that asset sort of up market through their various fund products. So I think that that's super, super interesting. And I think we're at the very early days of that. The second thing that I'll mention is I really believe, and I know I'm not alone, but I really believe that we're entering this golden age for Main Street business. I keep hearing everyone say, like, man, the market is so frothy. Man, like giving all these anecdotes, and they're not wrong. They're not wrong. But I really believe that we're going to have these situations. The CEO of Anthropic said about a month ago that by 2020, we're going to have an operator who is a solo operator for a big business that's worth $1 billion. Who knows? I mean, that's hyperbole. Who knows if they're right or they're wrong? But I do think an analog or a flavor of that is going to start to show up at the subscale of the market. I do think that these small home services businesses, these small IT services businesses, the idea that they trade at 4 times cash flow, we're going to look back in 15 years and we're going to say, man, that was a moment in time. Like, because I think what's going to happen is a lot of these new AI tools will allow us, from a back office perspective, to be able to manage these small businesses with a solo operator. Now, that's important from a margin enhancing perspective, but I'm actually much more excited about what it means from a predictability of outcome perspective. If I have to have 3 people managing the back office to do procurement, inventory management, customer service, sales and marketing, all of these things, that means I've got to do hiring around that. I've got to sell my culture. There's going to be disputes. Maybe this person who's doing the back office doesn't move as fast as that person or me or whomever. When I have the ability as a solo operator to be able to fully handle the back office largely through AI agents, and we're really beginning to see the early days of that, what that's going to allow me to do is handle all of the sales and marketing and CS and scheduling and inventory management much, much faster, much more efficiently. And now all I've got to be good at is working with my techs in the field, which is not easy. But if I can just develop a proficiency around that, I'm going to be able to grow this business so much faster and on a compounding basis. And that's why I think in 10 or 15 years, we're going to see a lot of situations where people are really going to covet these businesses in a way where they don't today. It's always been about owning the means of production. Today is all about this stratification about joining the investor class. And I think what we're going to find in 10 or 15 years is that there's going to be this huge value that's attributed to folks that own these small, resilient businesses that are profitable, and that are sort of necessary for our communities. And that's one of the reasons why I'm so excited to transact in this space today, because I do think, even though it's frothy, I do think we're at the front end, based upon some of this AI technology, we're at the front end of this new chapter that's going to be really, really exciting. And I just want to be a part of it.
Well, I feel fortunate to be a part of it, and you're certainly a part of it. I mean, you worded all that so elegantly. I think that's what everyone's thinking, or at least everyone who's watching this. So appreciate you taking the time and sharing some of your great insights with us, Brian.
For everything that you're doing for this community. You're doing a wonderful job, and I'm thankful to call you a friend, and I really appreciate you having me on today.
Likewise. Talk to you soon.
Thanks. Take care.